In the first half of 2026, U.S. stocks delivered their best first-half performance in many years. The Dow Jones Industrial Average rose a cumulative 8.85%, the S&P 500 gained 9.55%, and the Nasdaq Composite advanced 12.79%. The Russell 2000 surged nearly 22%. The Philadelphia Semiconductor Index posted an astonishing gain of about 101.1%. Strong earnings fundamentals among technology companies supported this rally. But beneath the surface, prosperity, the structure of the market is changing. The weight of the top 10 constituents in the S&P 500 has climbed to nearly 40%, setting a new historical record. Across the market, capital continues to concentrate in AI computing power and leading software companies. The siphoning effect of existing capital keeps squeezing the allocation space for other sectors. Market breadth has fallen to its lowest level since the dot-com bubble era. Entering the second half of the year, the framework of using the Magnificent Seven to assess the market's growth momentum has already failed. The correlation among the seven stocks has declined significantly. At the same time, the Federal Reserve's high interest rate environment continues to suppress the elasticity of high valuation assets. Since July, capital has begun to move out of overcrowded chip stocks and AI picks and shovels names, spreading into broader areas such as industrials, healthcare, materials, and small and mid-cap stocks. In July, high-flying technology stocks, represented by SanDisk, suffered sharp pullbacks. The sudden decline in AI-themed stocks reflects a rapid shift in market sentiment. We believe that the current U.S. stock market, especially the high-tech-related areas, is already in a bubble-on-bubbles situation. Two layers of bubbles are stacked on top of each other, supporting each other while also amplifying each other's risks. The surface-level bubble is the price itself. AI-related stocks, such as Nvidia and SK Hynix, experienced several-fold gains from 2025 to the first half of 2026. Their share prices already contain an extremely high assumption that AI will continue to grow beyond expectations. The underlying bubble is the earnings expectations that support those prices. Wall Street's earnings forecasts have already been built on a demanding combination. AI revenue will continue to accelerate, capital expenditures will not erode profits, and the cost miracle will continue to occur. The two layers of bubbles support each other. High earnings expectations support high stock prices. High stock prices, in turn, require the next earnings report to remain exceptionally high and above expectations. Once earnings growth is not extremely high beyond expectations, both layers of bubbles come under pressure at the same time. Earnings expectations are revised downward, and valuation multiples contract in sync. On July 29th, SK Hynix released one of the most impressive earnings reports in its history. Revenue reached 79.32 trillion won, up 257% year-over-year and setting a new record high. Operating profit reached 60.54 trillion won, up 557% year-over-year. Net profit reached 93.92 trillion won, surging more than 12 times year-over-year. All three indicators set single-quarter historical highs. After the most impressive earnings report was released, the stock plunged 9%. SK Hynix has fallen sharply from its June high. It is not the first AI supply chain company to fall after a perfect earnings report, and it will not be the last. On July 27th, Nvidia's share price fell nearly 5%, breaking below $200. Its market value dropped by about $250 billion in a single day, ceding the title of the world's most valuable company to Apple. Reports said that Nvidia was in talks to provide about $250 billion in financing guarantees for OpenAI to help it lease data centers. It was also discussing another $350 billion in chip purchase financing. To maintain the pace of demand growth, Nvidia has begun to take on financial risks that do not originally belong to a chip company. Its income statement remains brilliant, but the credit market has already sensed the smell of leverage. Alphabet raised its full-year 2026 capital expenditure guidance to $195 billion to $205 billion. Its quarterly free cash flow turned negative for the first time in decades, at negative $5.9 billion. After the results were released, the stock once fell more than 4%. On July 23rd, the Magnificent Seven lost about $797 billion in market value in a single day. The valuation premium of the seven giants relative to the other constituents of the S&P 500 has fallen to its lowest level in more than a decade. This means that some capital is reassessing these companies' earnings quality and cash flow quality, rather than focusing only on revenue growth. The market is moving from believing in demand to examining returns. Concerns about circular financing and the pressure of a broader valuation reassessment of AI chips have also spread to the entire semiconductor sector. In the overall sell-off in chip stocks, AI chip-related companies have all come under pressure. In addition, Micron, AMD, Broadcom, and Marvell all face structural pressures similar to those facing SK Hynix. Overall, market volatility at elevated levels is intensifying, and capital rotation is accelerating. It is not suitable to hold a single-type portfolio. The watch list should include defensive stocks, as well as a small proportion of high-volatility stocks with profit potential. To get timely information that meets this expectation, please follow our channel. In the next episode, we will continue to select 3 stocks in each episode that meet the above requirements. We look forward to your interaction and comments.